The recent surge in the stock market and Bitcoin value can be attributed to the Federal Reserve's decision to resume printing money. This has undone several months of quantitative tightening lasting around 5 months. Despite the Federal Reserve's claim that it's not quantitative easing, they're also not ruling out the possibility. Essentially, the current situation involves a new approach that cannot be categorized as straightforward money printing or not. Let me explain what's going on. The Federal Reserve's primary goal is to reduce inflation by implementing quantitative tightening measures, which involve reducing their balance sheets and removing money from the economy. However, when the banks got into trouble, the Federal Reserve stepped in and expanded their balance sheets by a net $320 billion in March. Although the Fed did not purchase treasuries, the Federal Reserve claims that this technically does not qualify as quantitative easing. However, it's very important to understand the truth of what's happening. In this video, you will understand exactly what's happening. The Federal Reserve's claim that they're not implementing quantitative easing because they have not created new money is false. By launching their Bank Term Funding Program, BTFP, they allow banks to use their treasuries or other assets as collateral at par value. Although the Federal Reserve is not directly buying treasuries, they're still injecting cash into the system while providing par value to the banks. Therefore, the reality contradicts the Federal Reserve's assertion that they're not implementing quantitative easing. Consider this scenario. If you offer a treasury bond worth $70 and the Federal Reserve provides you with $100, then it's essentially money printing. It involves introducing new money into the system which did not exist before and is above the fair value. The Fed is saying this is not money printing. If this situation does not qualify as money printing, I don't know what is. Let me know in the comments down below what you think it is. Although we have to agree with a certain aspect of their statement, which is that if the loan is repaid and the collateral is returned, the balance sheet will shrink, resulting in quantitative tightening. However, at present, their actions amount to quantitative easing. While it may not be as stimulating as providing stimulus checks, it still involves printing money that's masked as something else. Thus, their Bank Term Funding Program serves as a backdoor method of quantitative easing. The Federal Reserve's balance sheet is expanding, and so are the reserves. It's very important to know what's happening with the Fed. The current situation is more complicated and problematic than what you may believe. For instance, did you know that the Federal Reserve is experiencing significant losses? They're losing billions of dollars every week due to the trillions of dollars worth of treasuries and MBS they've purchased and the interest they need to pay to the institutions that hold their money. Since September, the Federal Reserve has suffered losses amounting to nearly $50 billion. It's worth noting that when the Federal Reserve generates profits, they typically send the majority of it back to the U.S. Treasury, which amounts to roughly $100 billion annually. However, this year, the Federal Reserve is projected to lose more than $100 billion. It's important to understand that when the Federal Reserve incurs losses, they resort to printing money to bridge the gap. While the Federal Reserve transfers profits to the U.S. Treasury, they print money to make up for losses. For over 100 years, the Federal Reserve has never reported an annual loss. However, the current projections suggest that the Federal Reserve is expected to continue incurring losses every year until 2026, which highlights the gravity of the situation. However, this is just the beginning. A case in point is Silicon Valley Bank, which collapsed because they had a large number of treasury bonds. When interest rates increased, the value of the treasury bonds fell, leading to massive losses. Similarly, the Federal Reserve is also in a similar situation where its Soma portfolio is underwater because all the assets were purchased when interest rates were considerably lower. Consider this. Not only is the Federal Reserve losing billions of dollars every week, but they're also carrying a colossal amount of unrealized losses that are estimated to be around $1 trillion. When compared to Silicon Valley Bank's losses due to falling treasury bond values, the Federal Reserve situation is vastly more severe. It's ironic that while they're trying to rescue the banking sector, their own financial standing is rapidly deteriorating. This situation is nothing short of a looming catastrophe. I want to inform you what's happening in the stock market, and be completely honest, I want to share the truth with you. The economic system in the United States is not a free market economy. In a free market economy, supply and demand control the system with minimal government intervention. However, the American economic system is more centrally planned than most people realize. Let me give you some examples. Who do you think controls the direction of the housing market? Do you believe that the direction of the housing market is determined by buyers and sellers or by mortgage interest rates set by the Federal Reserve? The truth is that there's no real price discovery, as we're at the mercy of the Federal Reserve, with bubbles forming and popping. Furthermore, when it comes to determining whether we'll experience economic booms or busts, it's not based on businesses, consumers, or productivity, but on whether there's easy monetary policy in place by the Federal Reserve. The same goes for the direction of the stock markets. It's not about companies out-competing each other, but about whether there's quantitative easing or tightening by the Federal Reserve. The American economic system is more centrally planned than many realize. It's widely acknowledged that the Federal Reserve holds tremendous power in determining the direction of the economy, housing market, bond market, and stock market. However, very few people are courageous enough to admit this truth. Let's face it, the central bankers have gained too much power, and historians will likely write about this era in the future. But today, our focus is on the Federal Reserve's role in the stock market. It's been proven that there's an 87% correlation between the stock market's performance and the Federal Reserve's quantitative easing policy, which I've previously discussed. The stock market's been experiencing an upward trend due to the Federal Reserve's money printing and market psychology. When the banking sector has started to face difficulties, the Federal Reserve has taken urgent action to address the situation, including emergency meetings and the establishment of new lending facilities, essentially going to great lengths to assist. The stock market anticipates that the Federal Reserve will provide support if needed, known as a Fed put. It's understandable why the stock market has this expectation, given the Federal Reserve's recent actions. Despite Chairman Jerome Powell's attempt to appear tough, the market saw through it and the Federal Reserve quickly backed down. This response is likely to be counterproductive in the fight against inflation, but the full extent of the consequences is uncertain. Let's consider the known dangers that lie ahead, though there may be unknown ones as well. Look at the banks, they haven't completely recovered. And then there's commercial real estate, which could make things worse. If something goes wrong, particularly with the banks, we can expect the Federal Reserve to print more money and expand the balance sheet excessively. There are 4 possible outcomes in this situation, in my opinion. The first is a recession, followed by high inflation, stagflation, or a soft landing. What do you think will happen? I want to take a moment to share my personal opinion with you. I don't think we'll experience an economic depression in this cycle, despite the Federal Reserve being in a difficult position. I believe there's enough room to maneuver and enough economic flexibility to avoid a depression. To be honest, it's hard to imagine that the Federal Reserve could mess this up. They have a lot of tools at their disposal. At the moment, they're actively involved in managing the banking crisis and trying to engineer a soft landing. But if they come to the realization that a soft landing is not possible, then they'll need to choose between a recession, high inflation, or stagflation, whichever outcome they deem the most tolerable. In my opinion, this is how the scenario will unfold. It's important to keep in mind that the U.S. economy is highly manipulated, and once the Federal Reserve realizes that a soft landing is unattainable, they'll opt for a recession. During this time, unemployment will rise and zombie companies will go bankrupt. However, inflation, as measured by CPI and PCE, will continue to decline. Eventually, the economic pain will become unbearable, and this is when the Federal Reserve will shift its monetary policy and make what's known as a Fed pivot. They'll choose to accept higher inflation for a less severe recession. In my upcoming video, I'll provide you with an update on the Fed pivots. However, it's worth noting that many investors view a Fed pivot as good news for equities. Yet, based on historical evidence, I previously mentioned that a Fed pivot marks the beginning of a bear market rather than the end of it. Typically, the collapse occurs following the pivots. Furthermore, Bitcoin has been surging in value due to its perceived ability to serve as a hedge against financial instability and bank runs, which was the original intention of its creator, Satoshi Nakamoto. However, it remains uncertain whether BTC or other cryptocurrencies will continue to be treated as a safe haven or be treated similarly to traditional stocks listed on the Nasdaq. These are topics that will be explored in upcoming discussions, but the overarching theme is that the Federal Reserve and its decisions remain the driving force behind the economy. It's crucial to understand this truth and the workings of the game. Nonetheless, the situation is becoming increasingly precarious as the Federal Reserve's credibility is being questioned, and like any bank, confidence in it must not be lost. So I'm going to keep you updated. Please subscribe. Thanks for watching. Until next time.